Hey everybody, this is Greg Gossett from Gossett and Trading and Mentoring, and today is Saturday, December 9th, 2023. I hope you're all doing well. I hope you had a good week in the markets, and thank you for coming to my Weekend Review podcast. In this podcast, the format will be as follows. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to talk about when I entered them, why I entered them, what strategy I was using to enter them, and then most importantly, how I am going to manage the trade going forward, either to the upside or to the downside. I apologize for getting this podcast out a little late today. I had something to do this morning and I couldn't do it. But while I was driving home, I was thinking about, the points that I wanted to make in this podcast. And I have mentioned this in more recent podcasts, but I think it's very important, everyone, that you need to be very patient with your winners and you need to be very impatient with your losers. Now, most traders, and more of a human nature type of thing, we want to be patient with our losers because we feel like they're going to come back for us, and we want to be and they're very impatient with their winners because they want to take those gains real quickly because it feels good. But to be a long-term profitable trader, you need to do the opposite, everyone. You need to have a process that lets you stay in winning trades and a process that gets you out of losing trades very, very quickly. That's the math. That's the calculus in trading, is being patient, waiting for a good setup, waiting for a confluence or combination of indicators at important levels that are rejected, position sizing for the current volatility of the market and the size of your trading account, and then having a very, very good risk to reward ratio. So if you are wrong, you know exactly when you're wrong. You had that line in the sand. If I'm above the 200-day moving average, I stay. If I close below, I'm out right away. And what you'll see from my trades that I'm going to go over with you today is that, yeah, I have losing trades, but when I have them all the time. I wish I didn't, but I have them all the time. But the one thing that you'll see is that when I am in a winning trade, I am in it usually for a long time until it tells me that it's not the correct trade anymore. When I'm in a losing trade, you'll see that I'm out of the trade quickly. I can always get back in if it gets back over my level, right? But you'll see when I have losing trades, I am not in them very long. I am out. When I am in winning trades, I have a process that keeps me in those trades. Now, I always take partial profits as it moves up, which I'll get into and show you. But you need to have yourself a process, everyone, because if you have to make just quick decisions, emotional, impulsive decisions on getting in or getting in your trade or out of your trade or when to, it's not going to work out for you in the long run. You need to have a complete process in trading, and that's what I'm going to try to show you here today. Okay, so we're going to take a look at all my trades, both on the daily charts and the weekly charts, when I entered, why I entered, how I'm going to manage them going forward. After that, we're going to talk a little bit about trader psychology. Trader psychology is a very important part of your trading. It is a skill, just like any other skill in trading of, looking for setups and looking for confluences. It is a major skill, and one could argue that it is the most important skill. So I always like to cover trading psychology. It's always good for me to teach, helps me, and I hope it helps you. So I hope by going over these trades, you get an idea of how I trade, what I look for, the confluences I look for, and the process that I use. So hopefully this will be helpful for you. After trading psychology, I have gone down through my watch list, both on the daily charts and the weekly charts, and I'll show you the trades that I am potentially looking for next week. And I think the exercise, I do this every weekend when it's nice and quiet and the charts aren't blinking at me and motions are not running high. I just look very objectively at the charts and go, okay, this particular market, whatever I'm looking at, it is not where I need it to be. But if it does get there next week, then I will potentially take that trade. And what am I looking for? If I'm looking to get long, I'm looking for some kind of confluence or combination of support below me, whether that's the 30 RSI, the 200-day moving average, the 250-day moving average, the 30 RSI, bullish divergences, V1s, V2s, and ideally, though a lot of those happening or multiple of those happening at the same time. Um, I studied one-on-one with Dr. Alexander Elder, and he said, Greg, it's very important to make money in the market that you look for combinations, confluences of indicators lining up. And that's why on the weekend, sitting here, going through the charts one by one and saying, okay, stock XYZ, if it gets down to this level and it has a bullish divergence and it also rejects this major 200-day moving average or 30 RSI, or ideally both of them, and maybe it has a V1, it has a V2, and they all come together, it certainly doesn't guarantee you a profitable trade, but it really does improve your chances. So that's what I'm going to show you, the work that I did last night of what these potential markets going forward, looking for the potential entries. Maybe I'll get them, maybe I won't. But I've been trading for 28 years, and I can tell you it's one of the best things you can do. Be very patient. Let the market get to the level that you are looking for. If it doesn't get there, don't mess with the trade. It doesn't mean you're being lazy. It just means that the more patient that you are and you let the trade come to your level, doesn't guarantee it a profitable trade, but it's such a good exercise. And if it does get to that level, even if you're wrong, most likely you're going to be wrong small. And if you're right, there's a very good chance you could be right big as well. All right. So I'm looking at some both long trades for next week and also some short trades for next week. Of course, we've had this huge market rally stampede. I don't have as many long entry potential candidates for next week as I usually do for you. And I have more shorts. And listen, doesn't mean the shorts are going to work, right? I have a couple shorts right now. They're both working, but I'm fully aware that with this bull market that they may not work. It's okay, but they're legitimate signals nonetheless. So be patient, wait for the trades to come to you, and hopefully by taking a look at what I'm looking at next week, this will be helpful for you as well. So that is the format for the podcast today. Let's go ahead and run that U.S. legal disclaimer, get that out of the way, and I'll be back in about 40 seconds. Hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. Hey, I forgot to mention too, had one of my viewers write in and say, hey, Greg, would you mind trying to highlight one of the day trades that you do as well? So yes, I have a day trade on there that I took on Friday that I'll show you as well, because with the strategies that I use, the setups that I use, they work on all time frames. And by the way, if you're learning a strategy, it should be what is called robust. Robust means it should work on any market, any time frame, and all the strategies that I use are robust. So I will show you something on TLT. It was the day trade that I took. And by the way, as we go through these positions that I have, I'm going to show you a lot of rules, and you may think, oh boy, there's a lot of rules there. But listen, you need to have a lot of rules. I mentioned earlier in the podcast that you need to have a process, and a process isn't just where you get in and where you get out. It has to do with a lot of things: position sizing, end of day stop, emergency stop, taking partial profits as the market moves in your direction, tightening your stop when it gets to a certain level, looking for major resistance levels and price action at those major resistance levels. And that's what I'll show you here and what I'm doing. But if you are interested in learning this one-on-one with a coach, I do provide private one-on-one lessons in the evening time via Skype. I love to teach. I've taught people from all over the world. I've been trading 28 years. I've taught people from absolute beginners all the way up to hedge fund managers and everywhere in between. So if you are interested, like I said, I do teach a private one-on-one course. My email is the link in the description if you're interested in studying with me and having me teach you step by step all the 5 different trading approaches I use. Just contact me. We'll start a discussion, and you'll learn a skill that you could use for the rest of your life. All right, so let's get started. Here we go. Caterpillar. All right, so I talk about confluences, combinations of indicators lining up. I did get long Caterpillar all the way back here on the 1st of November. Well, it's the 9th of December. So if I'm still in this trade, what does it mean? It means that it's profitable, right? I've been in some trades all the way back, I don't know, months and months and months. I'll show you those in a minute. But here's Caterpillar. I did buy Caterpillar on the 1st of November with the confluence of signals which will follow. The previous day we closed under 30 RSI, then we closed over 30 RSI. The previous day we closed under the 300-day moving average. On the entry day, it closed above the 300-day moving average. These are 2 very strong signals, deep dip buy signals. Under 30, over 30, close under 300, close over 300. That is why I took the trade. Now, as soon as you take the trade, you have to decide, well, how many shares to buy, right? That's what I mean by position sizing based upon volatility. And this has to do with how much is in your account, right? So let's just take a hypothetical $100,000 account. A good rule of thumb is 1%. So if you have a $50,000 trading account, your maximum allowed loss could be $500. If it's 100,000, 1% is 1,000. If you have $1 million trading account, 1% is 10,000. So it all depends on what the trading account is. And so for this explanation here, we're just going to go with a hypothetical $100,000 trading account. So the way that I do it, it's not the only way to do it. I'm not suggesting this is what you have to do, right? But this is just how I do it. 1% of my total trading account, $100,000, 1% is $1,000. I divide it by the value of the 2 ATR. ATR means average true range. This is twice the average true range. So this is 2 times what it is expected to move. If it does move that amount, then I would lose 1% of my total capital, which is not fun, but you can recover from that. But the good news is only 5% of the time are you ever going to hit that maximum 1% loss. Only 5% of the time, 95% of the time, if you have a loss, it will be less than that. All right, so 1% of $100,000 is 1,000 divided by the value on the day that happens. Let's just say right now it's 938 divided by 938. That would tell me to go ahead and buy 106.6 shares. I would just round that up to 107 shares. So the way that I trade, that is the correct amount of shares based upon your total account value, the total volatility of the market. And so I'm buying, I have the under 30, over 30, the close under the 300, over the 300. That is my signal. I do the math based upon that $100,000 trading account. It tells me to buy 107 shares. Okay, boom. I buy the shares. Now, the first thing I do is I place my emergency stop exactly the value of 2 ATRs, which is 9.38 below. This is this red line. So in the future, had it come down to this line, I would immediately sell. And how much would I have lost? I would have lost that 1%. But that's my emergency stop. My end of day stop is usually just the untriggering of why I got into the trade in the first place. So under 30, over 30, under 300, over 300. You can see it close right over the 300. I got long at 231.60. So when I see the entry signal, I position size. I place my emergency stop. My end of day stop simply going to be a close under the 300-day moving average. Then at that point, what I do is I add 1.5 ATRs, right now it's 703, above my entry. So emergency stop is the value of 2 ATRs below. My trailing stop level is 1.5 ATRs above. And if I ever get to that, then I go into what is called trailing stop mode, which means if I have a close below a previous bar's low, I will get out of half. I'm tightening up the stop. Now, before we move forward, I like to play offense and defense. Everything I have discussed so far has been defense. Looking for combinations, confluences of indicators, placing position size incorrectly, knowing where your emergency stop is, knowing where your end of the day stop is. Even trailing stop levels are defensive. But offensive means that if I move the value of 0.45 ATRs from the previous day's close, then I'm going to take off 10% of my remaining share. So let's just, here we are. I'm still in Caterpillar right now. It's 259.50. So 259.50 plus the value of 0.45 ATRs right now, it's 211. So I take the closing price plus 211. On Monday, my first profit target will be 261.61, somewhere up here. That will be my first profit target. Then I'll take my first profit target, add again the value of the 0.45 ATR to it again. My second profit target will be 263.72. My second profit target, 263.72, added again, 2.11. My third profit target for Monday will be 265.83. So I'll take 10% of the remaining shares. Let's just say I have, 400 shares left. 10%, 40. I would sell 40 at that first profit target, 40 at the second profit target, 40 at the third profit target, which is 265.83. And so I do that every day because the closing price, if it's lower, then my profit targets are going to be a little lower than if they had moved higher. All right. So hope that makes sense. But this is a very important part. Every good championship sports team always has to play offense, defense. The being patient, waiting for your setups, position sizing correctly, emergency stop, end of day stop, trailing day stop, all defensive. But the taking a partial profit into strength is offensive. All right. So confluence of signals. Position size based upon volatility. Place my emergency stop 2 ATRs below. My end of day stop, simply a close below the 300-day moving average. So bought here, 231.60. Next day moved up. Took a profit target because it moved up enough for me to take one profit target. Next day moved up again, not enough for a profit target, but it gets to trailing stop level, which means now in the future, if I get a close below a previous bar's low, I will get out of half. Next day moved down, but held above the close. So I held in there. Next day, this is the first close below a previous bar's low after reaching trailing stop level. I took off half of what I had remaining for a gain of 1.31%. Then we had 3 days of sideways motion. Keep in mind, if we had closed below here, I simply would have gotten out. Next day, moved up, not enough for a profit target. Next day, moved up, did take some profits off. Next day, not enough. Sideways, not enough. Then we had this little down motion, sideways motion here, took a profit target here, took a profit target, and on Friday took a profit target as well. So the remaining shares that I have on Caterpillar up 10.66%. This is a very good example, everyone, of being patient, waiting for the confluence, position sizing correctly, and having a very good risk to reward ratio. Again, I bought at 231.60. If the next day had simply closed 2 pennies, 1 penny below this 300-day moving average, I simply would have been out of the trade. So I have my process. I know what I am going to do here regardless. I have a nice profit in this. I can be patient with it. And again, be patient with your winners. Be very impatient with your losers. Now we're at a 62, 66 RSI level. If we move up, to where I'm at a 65 RSI level, then the 5 EMA will come into play, which just means if we get to a 65 RSI level and then close below the 5 EMA, that's my exit to just completely get out of the trade, lock in profits. Alternatively, if we get up to the 70 RSI level and reject that, then I will take off half of whatever remaining shares that I have. And then after that happens, if I get a close below a previous bar's low after rejecting the 70 RSI level, then I am completely out of the trade. So again, I know if you're new to this podcast, you're probably, boy, that's a lot of rules. How would I ever know that or learn that? Trust me, if you take my one-on-one course, I will teach you these rules until you know them. I will not let you go until you know them like the back of your hand, okay? So Caterpillar, the remaining shares that I have left, up 10.66%. Good trade. Google. All right, Google was a short. All right, I shorted Google here on the 22nd of November at 138.70. Why did I do this? Well, back here on the 24th, we have what's called an order block. An order block is an up bar before market structure changes to the downside. This was the up bar before earnings. We had earnings, they were bad, changed to the downside. So if the market ever comes back up into this order block, that's my signal to go short. So I did get short here, 138.70. I position sized. I placed my emergency stop 2 ATRs above. Now on this, where is my end of day stop? My end of day stop's very close. It's just to close over the high of that order block, which was 139.36. If the next day it just popped its head up here and closed back above, I simply would have got out for a small loss. And of course, I have my 2 ATR emergency stop up here. And if it did get it there, pop quiz, how much would I have lost? 1%. You're right. Now, I placed my trailing stop level 1.5 ATRs below because this was a short. And again, if it moves down the value of 0.45 ATR, I'm going to get out of partial profits. So got short here, 138.70. Next day, moved down. I did cover some, locked in some gains, reduced my position size. By doing that, I reduce my overall risk, right? Next day, move sideways, nothing. Next day, move sideways. Next day did move down enough for me to take another profit target off. Next day did get to my trailing stop level, which is 1.5 ATRs below my entry, and moved down substantially. So I took more profit targets. Now, because I'm at trailing stop level, it means that in the future now, because this is a short, if I get a close above a previous bar's high, I'm going to take out half. All right. So took profit targets, took a profit target here, took a profit target here, took 2 profit targets here. I'm in trailing stop mode. Next day didn't do much. Next day we moved down again, took more profits off. And then this day here, the 5th, was the first day that we closed above a previous bar's high after reaching trailing stop level. So I covered half down here for a, what is that, 6.25% gain. And I've reduced my overall position size by half, which I'm glad I did, because now look, we had this big up rally here, but I covered half of it down here. So you can see on this day here, on the 7th, this could have been a day where I closed above here and would have had to get out with that second half, maybe at a small loss, but it never got there, never closed above. I kept short. Friday, we were down 1.94, and I took some more short profits to the downside. So still in the trade. The remaining shares that I have on this short are up 2.79%. Rio. All right, so Rio is what is called an abandoned baby. I really like these setups. One of them is called Abandoned Baby. The other is called an Island Reversal. If you like, go to my YouTube channel, and I have a video there in the playlist that talks about one of my new favorite trading indicators, Abandoned Babies and Island Reversals. And I do a nice video there that explains what I am doing. But I did get short Rio here on the 6th. So now I'll just show you. I highlighted in blue. An abandoned baby is something that has, you see how the previous day, see the bar here in the blue, see how we gapped up? So there was whatever, for whatever reason, the market sentiment became very bullish. We gapped up. And then the very next day we gapped down. So it went from all great news to all bad news. This shows that the sentiment went very quickly from positive to negative, and this shows that there's more of a likelihood that this is going to go down now than it's going to go up. So you see the gap to the left, you see the gap to the right. Now on this particular trade, a little different than the rest of my trades, when I have an abandoned baby or I have an island reversal, this, I don't use scaling out, I don't use trailing stops. I just have, I'm either going to make 4 ATRs or I'm going to lose 2 ATRs, right? So it's a good risk to reward ratio. It's still to do based upon a strong signal like an abandoned baby. So I did get short here on the 6th when we came up, closed the gap. This is a lot of resistance right here. You can see this is my emergency stop, 2 ATRs above my entry because this is a short. The green line down here, this is 4 ATRs profit. So this trade is either going to do one of two things, guaranteed. It's either going to stop me out at my 2 ATR emergency stop, or I'm going to get a gain of twice that to the downside. Make sense? So I got short here, 69.91. Next day went up, but it did get to my emergency stop? No, it did not. And then on Friday, it was down a little bit, which went my way. So right now, this particular trade slightly underwater. Oops, sorry. Gotta go the other way there. Very slightly underwater by 0.31%. But I do want to highlight in the past some of the results of abandoned babies and from island reversals. Let's go back in time here. I just highlighted these last night. Here is a bearish island reversal. Did it work out? It certainly went down. Here is a bearish island reversal. Did it work out? It certainly went down. Here is a bearish abandoned baby. Was it correct? It certainly was correct. Here is another island reversal. Was it correct? It certainly was correct for a while. Here is a bullish island reversal. Was that right? I would say it nailed it, right? So they don't always work, but they work more often than they don't. So now that probably puts into context a little bit of why I got short here. Doesn't have to work, but more likely than not, it will work. And if it doesn't work this time, it'll work the next time. But if I'm wrong, I'm going to be wrong 2 ATRs. If I'm right, I'll be right 4 ATRs. Make sense? And again, just go to my YouTube channel, look up the video on island reversals and abandoned babies, and I think you'll learn a lot from that. But this particular trade, currently down 0.31%. All right, next trade here, TLT that I did take on Friday. You can see the highlighted island reversal. So this is a short for me that I took. You can see we had here on the 6th, we gapped up. We had a sideways bar, and then Friday we gapped down. So when abandoned babies 1, island reversal is more than 1 bar. So this is a bearish configuration. Does it have to go down? Of course not. But more likely than not, it will. And if I'm wrong, I will lose 2 ATRs. If I'm right, I will make 4 ATRs to the downside. Makes sense? So just want to take a look back here and see how these TLT abandoned babies have done in the past. Let's see here. Did I erase what I was doing? Gosh darn it, I think I did. Well, anyway, look at this one here. This is an island reversal. Did it work? It certainly did. Oh yeah, here we go. Here's a bullish island reversal. That was nicely correct. Here's a bearish island reversal. That was definitely correct. Here is a bearish abandoned baby. This one did not work. But you can see from the ones that I've shown you here and from Rio, they work a lot more often than they don't work. So this is why I took the trade on TLT. We have an island reversal to the downside, got short 94.54, which is exactly the closing price. My emergency stop, 2 ATRs above. My profit target, 4 ATRs below. So this one is completely unchanged. So those are the current open positions that I have. The closed positions that I have, you'll see these are losses, but I was out very, very, very quickly. I got short here, IBB at 123.41. Why? Look to the left here. We got into this order block. My emergency stop is 2 ATRs above. My end day stop simply a close above the order block's high. So I got short here 123.41. I placed my 1.5 ATR trailing stop level below, but this one didn't work out. Next day moved down a little bit. Actually, I did take one profit off as it moved down. And then here on the 6th, we went above the high of the order block to the left, but closed below it. That kept me in the trade. Next day, Thursday, it did close above the high of the order block, and I got out for a small loss of 1.03%, which is fine. It's okay to take small losses, but you'll see I wasn't in this trade very long. I was in this trade 3 days because it didn't work out, and I simply got out of the trade. And then Walmart, exact same thing. I did buy Walmart. I really like this setup back here on the 1st of December. What was the setup? Well, intraday, we rejected the 200-day moving average. We also rejected the negative third ATR channel, which is important. I position sized. I got long 153.80. Of course, I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level above. Next day, moved sideways. My end of day stops are closed below the 200, by the way. Next day, moved up, was able to take a small portion of the position off at a profitable level, which was good. And then the very next day here on the 6th, we closed slightly below the 200. That was my signal to get out. It was a loss, a very small loss of 0.22%. And so the next day it continued down. Friday continued down, but you see why, okay, it's a loss, but a very, very small loss. It could have been a really nice gain, right? And I'm actually interested in buying Walmart again next week, and I have that on my charts for next week as well because we're getting some levels. But a good teaching example to show you of waiting for a good confluence of signals, position sizing, end of day stop, emergency stop, and it closed just slightly below the 200, just told me to get out of the trade for a very, very small loss, super small loss, right? And then I'm really glad it did because it has continued down. So here, a loss of 0.22%. All right, so just recap on the trades, but I'm going to show you that usually the winning trades are much larger than the losing trades. So Caterpillar, remaining shares up 10.66%. Google, short, remaining shares up 2.79%. Rio, down 0.31%. TLT, exactly even. IBB, very small loss of 1.03%. And Walmart, very small loss of 0.22%. That's proper trading, everyone. That's keeping your winners, having your winners be larger gains than your losers. That is proper trading. So let's go over now to the weekly charts. I like to trade dailies. I like to trade weeklies. Now, I have been in this trade for years, it feels like. But what does that mean? It means that it's a profitable trade, right? Okay, I got long XLF all the way back here, the 24th of March. I've been in this, how many months? like 9 months because it's been a positive trade. Why did I take the trade? Okay, purple line, this is the 250-week moving average. This is an important level of support. During that week, we went down, we went slightly below it, we rejected it, closed back above it. We also went underneath the negative third ATR channel, closed back above it. This is an important level here. 92% of prices when they get to the third ATR channel stop going down, move sideways, or go back up. So I'm not going to take the trade just based upon that, but in conjunction with it rejecting the 250-week moving average, that's the reason I took the trade. So at the end of the week on Friday, because that's when weekly bars close, I got long here at 30.70. Now, if you remember way back here, things were about as negative as you could possibly get. Did I listen to that? No. Did I listen to the news telling me why everything was, we were going to all live in bunkers and the world was ending? No, because the market told me that it rejected a level. So I position size, I got in, I placed my emergency stop 2 ATRs below, I placed my 1.5 trailing stop level above. Now the next week, had it closed below the 250, I simply would have gotten out most likely for a small loss. My maximum allowed loss would have been the total 1% of capital, right? But only a 5% chance of that happening. The other 95% chance of a loss would have been a smaller loss than that. So the next week it moves up. It moves up enough for me to take partial profits. Next week doesn't do much. Next week moves up nicely again, took more partial profits and got to trailing stop mode, which means if I have a close below a previous bar's low, I'm going to get out of half. We moved sideways for over a month, but we never closed below a previous bar's low. Then we had a nice up week here where I did take some more profits off. And then here was the first close below a previous bar's low after reaching trailing stop level. I locked in again on half of the trade at 6.40%. Then we had a nice month, over a month straight up where I continued to take more profits, more profits, more profits, more profits. And then we had a long period of just down, 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 down. Here, this is the important week here. Do you see the week of the 27th of October? Do you see how we went below the 250 and closed back above? Had this closed below the 250, I simply would have been out of the trade, right? Because that was my initial weekly stop when I took the trade. But it did go below and closed back above, kept me in the trade. Next week had a huge move up, took more profits. Next week, nothing. Next week, huge move up again, took more profits. Another week up again, took more profits. And then last week, didn't move much. So the remaining shares that I have on the XLF weekly trade up 14.93%. This is perfect example. If I was wrong, I could be wrong small, most likely would be wrong small. If I was right, I could have a outsized gain of 14.93%. And again, I've been in this trade for a long time because it's profitable. If it wasn't profitable, I would have been out quickly. And I have a process to follow that shows me exactly when to stay in, what to do. If you have a good trading process, you're never going to wonder to yourself, oh, what should I do? The rules are there. It will show you exactly what to do. So the remaining shares on XLF up 14.93%. Meta. All right, this is a weekly short trade. Here we go. So now, big picture, I did short here Google on the 1st of December, the week of the 1st of December at 334.60. Why did I do this? Okay, so let's put this into context. Here we have a very bearish setup. We have what is called a double top with a bearish divergence. So what does that mean? Well, look at the top here. Look at the MACD bars, which is an indicator of momentum. You see how they're all green, showing a lot of strong momentum. Then we pulled back. We had red bars. Then here, when I took the trade, we are higher here, than we are over here. So we should have more green over here than over here in a healthy market. But that was not the case. Here, even though we were higher, we didn't have any green bars. This is what's called a double top with a bearish divergence. All it means is even though we moved up, the move was not confirmed by momentum to the upside. Really, what it means is you're running out of buyers. And the implication is if you're running out of buyers, you're going to go down. So in addition, so we have a high, we have a higher high. Here we have strong bars confirming. At this high here, we have no green bars whatsoever. So this makes me bearish on the setup. In addition to that, ATR channels, here's 1, 2, 3, 4, 5, 6. Here at this high, we were at the 4th ATR channel. Here at this high, we were higher. We were not even to the 2nd ATR channel. This is what's called a ATR divergence. Another divergence, RSI divergence. Here, the RSI reading was very high here. Even though we're higher here, the RSI was lower. So in this particular case, we had a double top with a bearish divergence. We have a double top with an RSI divergence. We have a double top with an ATR divergence. These are all bearish structures, but I still needed, even though that was the case, I still needed a valid signal to get me into the trade, which gives me a structure to know when to get in, when to get out. I took the trade here on the 1st when we created a V2 to the downside. V2 consists of 3 bars. Bar 1, bar 2 went above bar 1's high, bar 3 closed below bar 1's close. I did this intra bar here, got short at 334.60. I wouldn't do this on any particular, just random market, only because we have all these divergences that I just talked about. And by the way, I do teach all of this in my one-on-one course, but that is why I took the trade. Now, a V2, your stop on a V2 is halfway of the washout bar. This is the washout bar the previous week because it went above the high and then below the close. So I got short here, 334.60. I position size by taking 1% of my total capital, dividing by the value of the 2 ATR, so it shows me the correct amount of shares to buy. I then place my emergency stop all the way, 40.39 above my entry, but my end of day or end of week stop on this is simply a close above halfway of the washout bar. This is the line here, 338. So next week, if we do close above 338, I'll simply be out of the trade. Remember, all the way up here, I only lose 1%. So if it closed up here, something like that, I might lose 1/4% or 1/3%, or it might keep going down. It started off the week very good. And I did take some profits off because it moved 0.45 ATRs from the previous bar's close. So here I took some profits off. Here I took some profits off. So I locked those in. Market can't take it away from me. And I'm continuing to decrease my position size, which reduces my overall risk. This orange line down here, what is that? That is my trailing stop level. Never quite got there. Well, last week we had a big reversal up. But you can see I'm very glad that I took that partial profit while I had it. So this particular trade, still profitable, but certainly not even close to what it was. This is up 0.63%. And then gold. I did exit my gold position. It was a really great trade. Here we go. I bought this all the way back here on the 6th of October. Why? Well, during that week, we went below the 200-day moving average, closed above. We went below the negative 3rd ATR channel, closed above. I position size. I placed my emergency stop 2 ATRs below. My end of week stop is what? It's simply a close below the 200. Never got there. So when I entered the trade, I placed my 1.5 ATR trailing stop level above. Next week, we got there immediately. I hit 2 profit targets right off the bat. Next week went up again, took 2 profit targets right off the bat, continuing to reduce my position size into strength. We had a couple weeks of sideways motion. And then here on the 10th of November was my first close below a previous bar's low. I took off half for a 5.71% gain. Next week we moved up again, took some more profit targets. Next week we moved up, not enough for profit targets. Next week we moved up biggies, took more profit targets off. Now this was key because here we got to the 65 RSI level. And if I get to the 65 RSI level, then if I have a close below the 5 EMA, I'm going to simply just exit the entire position. The 5 EMA is this light blue line. You can see on Friday we slightly closed below it. That was my signal to get out. I got out on the second half of my GLD trade for a gain of 8.63%. So the first half, gain of 5.71, second half, gain of 8.63%. My signal was the rejection of the negative third ATR channel and the 200-day, 200-week moving average. But look, see the see the blue here? We were talking about abandoned babies. Look, this is an abandoned baby to the downside. We gapped down, and then we immediately gapped up. I did not take the trade because of the abandoned baby. I took the trade because of the 200-day moving average, but I just did notice that they're, in addition to the rejection of the 200-day moving average, they're also an abandoned baby. And you can see it worked out. So really great trade. Closed out the trade. I'm out of gold for a gain of 8.63%. All right, that's it. So recap on the weeklies, XLF, remaining half, remaining shares up 14.93%, Meta up the short up 0.63%, and GLD remaining or out of the trade for a gain of 8.63%. So I just showed you all the dailies, I just showed you all the weeklies, but you know, what's the takeaway? They weren't all positive, were they? But the losing trades were small. The losing trades didn't work. I got out of them quickly for small losses. The winning trades, some of these I've been in for many, many months because they've been winners. So again, everyone, get yourself to the point to where you find a process that lets you stay in winners, but gets you out of losers quickly. That's how you're going to make money trading. Okay. And as I mentioned, I just quickly want to go over a day trade that I took because I did have some requests, and you know, this was on the 5-minute bars. Okay, you know, I like under 30 over 30s. Well, here was an under 30 over 30, but there was nothing. That was all there was. I like to look for confluences of under 30 over 30s. So look at the low here. You see how deep the red MACD bars are? Look down here. Are we lower here than over here? We certainly are. But you see how we have no red bars over here? This is telling me from a MACD perspective that you are running out of buyers down here. Otherwise, the red bars at this low would be deeper than here. So this is a double bottom bullish divergence. Now you don't just buy because you have a double bottom bullish divergence, but it sets the stage that if you do get a legitimate entry signal after having a double bottom bullish divergence, that you might want to take the trade. And that's exactly what I did. Look at this bar here. The RSI here was still under 30 RSI. So I'm not going to take the trade. But I did like that we rejected the negative third ATR channel. And I noticed, okay, we've rejected the negative third ATR channel. We have a double bottom bullish divergence. If I get a close back over the 30 RSI, I'm going to take the trade. So this is a trade I took on Friday. Next bar, up. It closed, well here, let's do it this way. Okay, on this bar here, it was 2480. So that's a no-go zone because it's not above the 30 RSI. But again, the way that I looked at it, I mean, this was the view that I had on the day. Double bottom, bullish divergence. We're near the negative third ATR channel. That's telling me statistically, more likely than not, we're going to go up. But it's, even though we have the double bottom bullish divergence, even though we're at the negative third ATR channel, I'm still not going to take the trade unless I get the signal. The next bar closed at 31.45 on the RSI. That's my signal to take the trade. I position size, I place my emergency stop 2 ATRs below. Where's my end of day stop? Well, if I took the trade because it went under 30 over 30, then if the next 5-minute bar closed back under 30, I'd be out, but it didn't. And it had a nice move up. So I got into the trade here for 15 minutes, moved sideways, didn't do anything. Then I had a nice big up bar here where I took a partial profit because it went my way. Okay. Next bar moved up again, took some more partial profits. Now it moved 1.5 ATRs from entry, so that means if I get a close below previous bar's low, I'm simply going to be out of the trade. Then we had moved sideways, sideways, sideways. We moved up a little bit here, and then we had another nice big bar up here where I took some more profits off. Next bar moved up again, took some more profits off. Next day, or next bar, because these are 5-minute bars, moved up again as it approached the 50-day moving averages, or the 50-period moving average. I took some more here near the top because I knew we were getting into resistance. Now I'm in trailing stop mode. This bar here was the first close below the previous bar's low. That's where I exited the trade. So this is for Greg, one of my viewers that was asking me for this, but double bottom, bullish divergence, looking for a valid entry signal. The valid entry signal came with the under 30, over 30, because of the context of the double bottom bullish divergence and the rejection of the negative third ATR channel. So got long here. Emergency stop or end of day stop would simply be a close back under the 30 RSI, which never happened. And then as it moved up, I took profits on the big bars, got to the 50-period moving average. That concerned me a little bit, took some more, and then this is the first close below the previous bar's low. So all in all, I mean, this is an intraday chart, so not a lot of range here, but still a 36 cents move here, you know, good for a few $100s for an hour's work. So pretty good. So anyway, I hope that's helpful, Greg, in seeing this on the on for day trading as well. All right, so before we start looking at potential trades for next week, I quickly want to talk a little bit about trader psychology. This is from Tony Stark over on Facebook, and he shared a really good post here from Larry Tentarelli. Larry's been around a long time. Very well-known trader, and he has some great advice here, and he's from Blue Chip Daily. You can follow him at LMT978. Let's see what Larry has to say today. We can either trade what we see, or we can trade what we think. If we trade what we see, we stay objective to price and react, knowing what to look for in each direction. If we trade what we think, it's easier to fall into the trap of directional bias and fighting the tape. And if you've been trading for a while, you know the value in what Larry is telling you here. Just a little while, I showed you that trade on XLF, the financial ETF, when it was down near the low. The news was so bearish at that moment that no one in their right mind was buying. As a matter of fact, at that moment, back in October, the highest amount of puts ever were bought because the sentiment was so poor, the news was so bad, and the last thing you wanted to do was buy anything, right? But if I was trading what I thought, I most likely would have been short with everyone else. But why did I buck the trend and get long? I got long because I was trading what the chart was telling me, not what I was thinking. I was thinking bearish, but the chart was showing me bullish. And the chart was showing me that it rejected the 250-week moving average. It gave me a structure for my trade. I have a process, so I knew exactly where I was going to get out, worst case scenario. I knew exactly where I was going to get out if I was wrong on the trade. And on that particular trade, it was just a close below the 250, but it never closed below the 250, and it just moved up dramatically as I just showed you. So that's a good example, good teaching moment. We can either trade what we see or we can trade what we think. So let's put it into real time. What I think, I'm super bearish on this market. Is the market going down? No, it is not. Okay, so I better trade to the long side as long as I have a bullish signal. Just like on the XLF chart, everyone was very bearish, but the chart told me to get bullish. Right now, I'm very bearish on this market, but the market doesn't care what I think. It's just going up. So if I'm going to take a short position, which I do have potential short positions next week, it should just be because I'm bearish on the market, just um, as a general fact. It's because it is rejecting some kind of important level. So one more time, we can either trade what we see or we can trade what we think. This is a good time to say don't have a directional bias on the market. Trade the signals of what the market's doing, whether it's rejecting signals to the upside, rejecting levels to the upside, or rejecting levels to the downside. That's the truth of what's going on, what the market's doing, not what your directional bias is. So we can either trade what we see or we can trade what we think. If we trade what we see, we stay objective to price and react knowing what to look for in each direction. Or in other words, if we trade what we see on the market, it lets us set up a construct of a trade. So if we're wrong, we're probably wrong small. If we're right, we can be right big. If we trade what we think, it's easy to fall into a trap of directional bias and fighting the tape. Imagine if you've been short for the last month. Not very fun, right? Doesn't matter what you think about the politics or about the economics of what's going on and the Fed and the this and the that. It doesn't matter. You would have been dead wrong and as the market rolled over you. So take Larry's advice. Regardless, have an opinion on the market. It's fine to have an opinion. Don't act on that opinion unless an actual signal lets you act upon that. So thank you very much, Larry. That's a great reminder to me and hopefully helpful for everyone else as well. All right, let's get on to potential trades for next week. And by the way, if you're finding some value in this podcast today, this evening, I would really appreciate it if you could hit the thumbs up. It's free. It only takes a second. It really does help me out, help to build the channel, help to keep the channel around. It lets YouTube know that you're liking what you're seeing. So I hope you find it valuable. And if you do, a quick thumbs up would really be appreciated. Okay, let's get to first on deck for next week. I have 5 potential longs on the daily charts for next week. Theoretically, all of these could trigger all at the same time. I'm not going to take them all if they trigger on the same day. I only like to take one trade per day. I like to trade the best trade of the day. And if they all triggered, why would one be better than the others? Confluences, combination of indicators. They all might trigger on one day, but one of them may have 3 setups, 3 signals. It may have stronger relative market strength than the others. The higher time frame may look better than the other. So it's kind of like a treasure hunt. These all could trigger all on the same day, but I'm going to use a fine-tooth comb and narrow it down to the best one. Which one has the best risk to reward ratio? Which one has the most confluences of signals? Which one has the strongest relative market strength compared to the rest of the market? What does the higher time frame look for? But that's what I like to do, is narrow down to the best one. And again, that is what I teach in my one-on-one courses, how to narrow down what the best one of the day is. So Alibaba, of course, you can see is very weak compared to the rest of the market. But what I like here on Alibaba, by the way, what really stands out to me is you see, of course, how we move down strongly. But you see how we're moving sideways now? This is showing that the market at this moment doesn't want to go down much. It's moving sideways. What does sideways movement mean? It means that there's an equal amount of buyers and sellers. One's not stronger than the other, otherwise it would be moving down or it would be moving up. So there are an equal amount of buyers and sellers here at this moment. Sideways motion. So that tells me that there's a good chance we're probably at a short-term low. Now, look at the RSI level, 2965. That's a no-go zone for me because it's under 30 RSI. But Monday, for example, if it closes above a 30 RSI level, I would definitely consider taking the trade, because then we'd have a close under, we'd have a close under 30 RSI, we'd have a close over 30 RSI. That is a legitimate signal. One of the strategies that I teach, the deep dip buy stock trading strategy, just an under 30, over 30. Now, here's the negative third ATR channel. Ideally, what I'd like to see on Monday is it gap up or close back above not only the 30 RSI, but also the negative third ATR channel. And again, the sideways motion is, I would consider, a confluence of signals as well. I mean, look, just down, little rally, down, 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 down. But now we have this sideways motion, which is important. So 29.65 on Monday or anytime next week, if we close above the 30 RSI, I would consider getting long BABA. Anheuser-Busch, BUD symbol. All right, this is a potential short. You might say, Greg, why would you short into this really, really strong market? Well, I look to the left, see the big up bar before the structure change. The structure, here we have a level of liquidity. We run the level above. We change structure. And the order block is the most recent up bar before the market structure change. I know it sounds confusing. And if you're not familiar with this, but again, one of the strategies that I teach in my one-on-ones, and this was the same strategy that I took to take that nice Google short. So here's the low of this order block bar, 64.80, the high, 66.32. Next week, if we close somewhere inside 64.80 to 66.32, that would be a legitimate short signal for me. And then where's my end of day stop? Simply a close above the high, 66.32. Just on IBB, I had the same trade, and that one closed above. I just had to get out for a small loss. But this is the area. This is the order block. Next week, I would consider getting short between 64.80 and 66.32 in this order block, which is a strong level of resistance. The Dow, DIA, same thing. Now this one is going to hurt your eyes because we go back so far, but you see this is an order block between 367.20, 369.20. If I take you all the way back to January of 22, there's your order block. There is your up bar move before market structure change between 637.20, 369.20, moves all the way years forward. That's the level. If we get into this level here next week between 367.20 and 369.20, I would consider getting short, and my stop is very close. If we close above 369.20, I'm simply out, most likely for a small loss. I don't know if we're going to get there. That seems like an awful long, a long way up. That's, several 300-400 points on the Dow. But in this market, it could get there. But that's what I would consider getting short. DIA, 367.20, 369.20. I'd position size, place my emergency stop 2 ATRs above my entry. My end of day stop would simply be closed above 369.20. NVIDIA. All right, well, NVIDIA is in a bearish market structure right now. Here's our high. We went higher, we ran the level of liquidity. Here on earnings, we broke the pivot point to the downside. This put us into a bearish market structure now. We've moved down, we moved down. Look, here is the order block before the market structure change. Anywhere between 492 and 506 next week on the daily. If it closes somewhere in between 492 and 506, that would be a short zone. Position size, ATRs, 2 ATRs above the entry. End of day stop, just simply a close above the high. That's it, the close above the order block. Gives you a very, very good risk to reward ratio. And then Walmart, again, I had an entry on Walmart last week, had a very small loss of 0.22%. Let's erase all this stuff here. I like Walmart here to the long side. Why? Well, let's look at this. Here's the negative third ATR channel. 92% of prices tend to stop going down when we get there. Doesn't always happen, but 92% of the price does. So I look at this chart and I go, okay, We're at the negative third ATR channel. That by itself is a decent sign if you want to get long, but it's not everything you need. You still need an actual trigger. But we are around a zone of a lot of important levels. 3 of them, in fact. 200-day moving average, black line. 250-day moving average, purple line. 300-day moving average, orange line. Look, we're at a 33.39 RSI. That's a very low RSI, and you're at a low RSI at the same time you're around these major levels. 200, 250, 300 is a major level anytime. 30 RSI is a major level anytime. But now here we are around these major levels, major moving average levels. We're at major RSI levels. We're at negative third ATR channel levels. So this is very interesting to me. And it's Walmart. You know, we had earnings up here. It's an order block, by the way. Earnings, they missed on earnings. It's been very weak compared to the rest of the market. One of the few stocks that I'm looking to the long side because everything else is so elevated. I'm not going to buy up there. There's no way. So I'm looking for a good company with a reasonable price at significant oversold major levels to give me a good trade to structure based upon those levels. So next week, we go down or we go up, I would be interested. My first thought here is the 250-day moving average. If we close above that 250-day moving average, I would definitely consider getting long because then I have the support of the 250-day moving average below me. If we go lower and reject the 300-day moving average, I would also consider getting long here. So right now, I just need it to go higher or lower. I would prefer that it goes lower because I would love to have a 30 RSI rejection of the 300. I'm sorry. I would like to have a 30 RSI rejection and also a rejection of the 300-day moving average. Let me remind you what that looks like. Right there, baby. It's the exact same thing. Under 30, over 30. Under the 300, over the 300. Was that a good spot to get in? It certainly was. So let's go back to Walmart. Do you see how we're looking at very similar charts? I mean, it's not quite there, but if it gets there, under 30, over 30, under the 300, over the 300. Let me pull up one more chart for you, and I'll just give you a little reminder. SPY. I bought SPY here. I'm out of the trade now. Look, under 30, over 30, under the 300, over the 300. Exactly what I'm showing you on Walmart. Doesn't mean Walmart has to do the same thing, but you can see that was a monster trade. So do you see why I'm interested in Walmart now? Because we are at those levels. Doesn't mean it has to work like SPY and Caterpillar. It does not, but it gives me levels to focus my trade on so that if I'm wrong, I most likely can be wrong small. But if I'm right, I have the potential, maybe we get up here. I don't know. All right, so real quick recap, Alibaba. I like the sideways motion. I would consider if it closed over the 30 RSI. Anheuser-Busch, I'm looking to get short Anheuser-Busch. If we get up into the order block, a short somewhere between 64.80, 66.32. The Dow, looking to get short in an order block between 367.20, 369.20. Nvidia, looking to get short in an order block between 492 and 506. And Walmart, looking to get long. We just need to go higher or lower. I would consider taking Walmart if we closed above the 250, or if it goes down. If it rejects the 300, that would be a legitimate entry. If it rejects the 30 RSI, that would be a legitimate entry. And ideally, if it rejected them both on the same day, that would improve the chances of that trade being positive. So that's what I'm looking for on the dailies. Let's take a look at the weeklies now. Remember, weekly bars close on Friday. So next Friday, I would consider these potential trades. Berkshire Hathaway, looking for a short trade. Here's the order block between 364.40, 370.90. Here's the up bar before the market structure change. So if Berkshire Hathaway tends to rally up in between this order block, I would consider taking the trade. Just because it does doesn't mean I'm going to. Remember, same as the dailies, on the weeklies, I'm going to take the best one. Maybe one has a V1. Maybe the other one doesn't have a V1. I'm going to take the one that has the most confluences of indicators lining up. So just because it gets here doesn't mean I'm going to short. One of these other ones might do a couple more things, which would make that more interesting and more likely for me to take that trade. But on the surface here, looking for a rejection, BRKB in the order block between 364.40 and 370.90. Johnson & Johnson, looking for a potential long. The 200-day moving average, you can see we got below the 250, moved above it, and then we had a nice big strong move over the 200. I didn't buy that because the risk to reward ratio was not good. But at this point, it looks like we're backfilling a little bit. We broke the trend line to the upside. Looks like we're backfilling a little bit. So Johnson & Johnson next week might be interesting. If it goes lower, goes under the 200 during the week, and then closes back above with a good risk to reward ratio, I would consider get long there. Or even next week, if it just bounces the 200 and closes a little bit above, giving me a good risk to reward ratio. If it bounces the 200 and then closes way high, I'm not going to buy that because now my risk to reward ratio is not good. So Johnson & Johnson next week, if it rejects the 200-week moving average, I would consider getting long J&J if it gives me a good risk to reward ratio. Of course, if it comes all the way down here to the 250, I would definitely consider that, but I don't know if that's going to happen. Who knows? I need to keep my mind open to that, but I'm first kind of keying off this 200-week moving average, but I have to keep the 250 in mind. You can see that was about as low as it got. I mean, it did close below the 250, so I guess I should say, to be more precise, next week, if we have a rejection of the 200, I would consider it. If we have a rejection of the 250, I would consider getting long. Johnson & Johnson, J&J. Tesla, okay, same thing. 200-day moving average below. If and only if we come back down, if we have a down week in the market and we come back down and bounce or intra-week reject the 200-week moving average, I would consider getting long. Just like right here, decent place to get long. Back test, just like I was talking about on Johnson & Johnson. This gives you a good risk to reward ratio, and that would have worked out really well. So I would consider getting long Tesla if and only if we come back down and somehow test this 200-day moving average. UNG, natural gas. My gosh, look at natural gas, everyone. I mean, back in 2022, this was $34. Now we are at $5. Okay, so am I buying it just because it's low? No, I'm not. I have to look at the big picture here. Look at this low here. You see the deep red MACD bars? It's kind of what I was showing you on the TLT intraday trade. Here's a low, deep red MACD bars. Are we lower here than here? Yeah, a ton. Do you have deep red MACD bars? You have a little red, but very little compared to over here. That is a double bottom bullish divergence. In addition to that, look, we're at the third ATR channel. That's important as well. But even though we have this double bottom bullish divergence going on, I still need a signal. There is no signal yet. Look, we're at 32.36. What I would need on UNG next week is for the bar to go under 30 and then close back above. I like the double bottom bullish divergence. I like the structure a lot, but I still need a signal to key off of so that I have a structure to take the trade. And the signal, the legitimate signal, would be an intra-week rejection of 30 RSI and close back above. That's what I'm looking for there. And then last but not least, VIX. I have been talking about VIX for many weeks. Has never triggered an entry, but I really like the levels of VIX at this point, and I really like the technicals. Look at this low here. We had red MACD bars, correct? Are we lower now? We sure are, but there's no red. That's a double bottom bullish divergence. Okay, not enough to take the trade, but from a big picture standpoint, I can tell. What does that mean, really? It means you're running out of downward momentum. If you had, I know this looks very momentous to the downside, but from a MACD perspective, it was not as strong as this move. So the implication is the momentum is slowing. What that means really is that you're running out of sellers. If you're running out of sellers, the implication is that you will be able to move up. In addition to that, we have very close to a wolf wave. What is a wolf wave? A wolf wave is a chart pattern that has 5 points. Point 1, point 2 rallies, point 3 goes below point 1, point 4 rallies, point 5 is the buy area. Point 1, 2, 3, 4, you can see we're almost to 5. And in addition to that, we have this double bottom bullish divergence. Right now, we're at a 2877 RSI. So what is my entry signal? My entry signal would be that it has to close above the 30 RSI. Okay? But I love an under 30 over 30 RSI while you have these double bottom bullish divergences. I want to show you real quick, talking about wolf waves. I mentioned this in a podcast, in one of my podcasts a long time ago. Oh, no, sorry. Was it? Oh, yeah, it's on the daily. Talk about wolf waves. I'll show you a wolf wave on the Qs. Okay, point 1, point 2, point 3, point 4, point 5. Point 5 is the buy area, and the projected move will be up here to the trend line. Did it work? It certainly did. Point 1, point 2, point 3, point 4. Point 5 is the buy area. We had very easy signals, under 30, over 30s, right here, and point 5 on the wolf wave. Did it work? It certainly did. So, keeping that in mind, over here on the VIX, does it mean it has to work? No, it doesn't have to work. But I've seen these wolf wave work over and over and over and over and over. Point 1, 2, 3, 4, 5. If VIX rallies and goes up, what is the rest of the market going to do? It's going to go down. And that's why I've been looking for short, a lot of the daily and weeklies that I showed you just in the last few minutes have been shorts. But the VIX, the wolf wave on the VIX and the double bottom bullish divergence on the VIX kind of validates my statement. But again, just because these are looking bearish on the market, these are looking bullish on the VIX, doesn't mean that that has to happen. We have to wait for actual signals to happen before I get long VIX or before I get short the market. Okay? So I hope that was helpful. Again, I'm going to pick from the best daily trade, the best daily time frame, trade, the best weekly trade. They could all trigger all at the same time. Doesn't mean I'm going to take them all. I need the one with the best confluence of signals, the best risk to reward ratio. They have to look good on multiple time frames. And again, that's very important to be able to whittle that down. So I hope that was helpful. I did mention a couple times about that I teach one-on-one lessons in the evening time via Skype. If you have ever considered seriously that you want to learn how to trade, I think the best way to do that is one-on-one with your instructor. That's why I offer the one-on-one format, and the lessons. The total session is 15 hours, 5 sessions. Each session is 3 hours. That's where you get your 15 hours. It's a total cost of $1,750. But I promise, for what you get and the time that you will receive, and the one-on-one mentoring and the instruction, it's really cheap, everyone. I promise you. I try to price it so that that regular people can take the trade, not just wealthy people or hedge fund people. So that, and like I said, I have taught so many people over the years from so many different countries. If you really want to learn this skill, just contact me and we can get the ball rolling. If Financially, you're not able to do one-on-one. I have a really good alternative for you. It's the deep dip buy stock trading approach on Udemy. I have the link in the description of this YouTube video. It's a great course. It's very affordable. There are 26 videos. There are 9.5 hours of video. There's 15 study guides. And in that particular video lesson, I teach you everything that you need to know about the deep dip buy stock trading approach. So again, one-on-one course, I teach you all 5 of the different approaches, and you get me one-on-one, which, I mean, that's better, but it's more expensive. But as an alternative, the Udemy course, very affordable. The link's in the description. Again, if you like the podcast today, I would appreciate it if you could hit the thumbs up button. And I always like to leave you off with, please try to go out and do something nice for someone today. If we all did one random act of kindness for another person every day, just think how much better that world would be if everyone on the planet did one nice thing for another person. It would just make the world a better place. And I think, based upon what's going on in the world and the trend, I think we could definitely use that. If I could ask one more favor, if you could try to do one nice thing for an animal each day, I know they appreciate it. I was raised with many animals. They were my friends growing up, and I know they appreciate acts of kindness. So if you could do one nice thing for another human, one nice thing for an animal, it would just make the world a better place, and it would be a better place for all of us. So thank you so much for spending your time here today. I hope it was helpful. I hope you learned something. If you did learn something, thumbs up would be much appreciated. But have a great week. Always trade carefully. Have your rules. Follow your rules. Don't get caught up into FOMO. And again, we are pretty high here. Don't get caught up into FOMO. All right, that's my best advice, and that's what I'm doing on my end as well. And God willing, I will be here next week, and we'll go over what's going on with this crazy market. So thank you so much, everyone. On the way out, I have to run the U.S. legal disclaimer, but have a great coming week and a great rest of your weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.